the listeners.
You're listening to Deeds in the Desert, where real estate investors tune in for the latest news.
Welcome to Deeds in the Desert. It's been a minute, but Pat and I are back. So welcome, everybody. This is going to be a little bit of a different episode. I just picked up Pat on my way in, sitting in his office, to ask him a few questions about a new loan that we have coming out. So, Pat, here you are. I was going to say Pat on the spot. We can't call you Johnny, can we?
Yeah, whatever.
All right, well.
As long as you're writing a paycheck, you can call me whatever you want.
Sign the check, Carrie, and I could be whomever you want. Well, we won't go with the nicknames that we have around here because they're probably not appropriate for this podcast. But nevertheless, we have an interesting situation. We were in a meeting yesterday, and we had some term sheets. We were looking at what we could fund this month, and you thought, hey, Carrie, what do you think about a $16 million loan? That is exactly what I said to you. Yeah. Pat, you do realize what day it is, right? And then you said, Carrie, I think we can do it. I'm like, all right. So we're going to do it.
Let's go.
Did we commit?
We committed.
Okay, well, then I'm glad we're doing this podcast. So this is interesting. $16 million. Why didn't you bring this up to me earlier?
Because we didn't have the deal earlier. We had the deal as of Thursday of this past week. We started getting the documents in place over Friday and Monday. We just put together the investment overview as of today, Tuesday, and now are ready to present to our investors on Wednesday. Okay.
You mentioned something to me that I don't think most of our viewers realize. And since I'm going to do a couple different things with this loan, I want to make sure that they realize that I'm not adding risk here by us being able to do the underwriting so quickly and those sorts of things, because this was around a little while. And a couple months ago, I kind of remember you mentioning this loan to me.
Yes, you had a term sheet on this exact same loan in September of last year. So we originally underwrote it quite a while ago. Yeah. We ended up not doing the deal, not because we passed on it, but because they passed on us. They were able to get cheaper financing elsewhere, or they thought they could get cheaper financing elsewhere, but that didn't quite come to fruition.
That didn't happen, huh?
No, it did not.
So are they kind of in a predicament at this point? Is that why they need it so quickly?
Absolutely. They have $1 million hard, non-refundable, applicable to the purchase price, where they have to close by the end of the month. If they don't close, they lose $1 million.
So this is quite interesting. You and I have talked about this before, where our borrowers say, you know what, we're going to pay off everything we have with you, and we're going to move on to something else.
Yes.
And you and I always laugh about it. We're like, all right, well, we'll see you in 3 weeks, right? We'll talk to you in 3 weeks. And we joke about that a little bit. But something that's not a joking matter is when a borrower goes hard on funds, $1 million, and is about to lose $1 million.
Absolutely.
So what exactly transpired over the last couple days with them contacting you? Because at this point, I don't want to say they're desperate, but if another lender falls through, that's typically when our existing borrowers reach back out to us. So a couple questions here. Is that what happened?
Exactly what happened.
That's exactly what happened. And then, has this group borrowed from us before?
So yes and yes. So the first question is the other lender. Yes, the reason they didn't go with our term sheet is because they had a cheaper financing elsewhere. Yep. So they started going down that path until middle of last week, when that lender that they had signed up with and paid a due diligence deposit with said, hey guys, we're only halfway through this raise. We're not going to be done by the end of this month. What do you want us to do? And they said, well, you promised you're going to give us the money. What do you mean, what do you want us to do?
Yeah.
We want the money that you promised us. Yeah. Simple as that.
There's no escape hatch here.
And it's not a matter of, okay, just pay whatever you got into it and we'll figure out the rest. It's all or nothing. And that's kind of the world we live in. It's either a yes or no. It's pretty binary and black and white. Yeah. And so the answer turned from a yes, we can do this loan from a previous lender, into a no, we really can't. We don't have the capital. We aren't going to have enough resources, and we simply can't get it done by the end of the month, and you guys are going to lose $1 million. So they came to us and said, hey, remember that term sheet you issued a while ago? What would change on that? And we increased our interest rate a little bit more.
Yeah.
And made a little bit more onerous of terms, because it is a little harder for us and the investors to turn things that quickly, to kind of recalibrate where we're at as a company.
Yeah.
We had other loans lined up that we've got to kind of maneuver around and make sure everybody's good with new funding dates to enable us to get this done. That answers question number one. Question number two is, have they borrowed from us before?
Yeah.
And the answer is yes. Schulman Properties, we first lent to them back in April of 2001, so about 4 years ago. And we've done, 3-4 deals with them, not all here in Nevada, but mostly here in Nevada, and some out in Florida as well.
Yep. But we don't currently have any loans with them.
None. They've paid everything off.
Okay.
Yeah. No current loans, and we haven't for about a year, almost 2 years now.
Yeah. So you're telling me cheaper isn't always better?
No. No, they always say you can get speed.
It reels you in.
Yeah.
It reels you in.
Right. Yep. You can get cost effective. You can get quality, or you can get speed.
Yeah.
And you can get two of those three, but you can't always get. You can't get all three. And for us, and for the borrowers, it's usually the cost is really what they have to succumb
overcome.
to. And these guys had to do it because the cheaper lending fell through. It was basically non-existent.
Yeah. Well, that's unfortunate and fortunate. Because,
unfortunate for them.
Yeah.
Very fortunate for our investors.
Absolutely, because now we need to raise the funds quite quickly. 3 weeks, that's pretty average for us. It's not super fast, but it creates opportunity, and opportunity without added risk associated with it.
Right.
So I got the fact sheet today, and I kind of did a double take, and I honestly thought to myself, why do we need to offer this at a higher interest rate when you have a 44% loan to value? But on the flip side, we need to move quickly, and we were able to have the borrower pay a little bit more. So guess what that means for our investors?
They get a little more.
Carrie's going to give them a little bit more, right? I mean, just pay it forward. Make sure that our investors have good loans out there. Talk to us a little bit about this loan. I mean, typically I'd have the borrower here, and you'd be interviewing the borrower.
Sure.
But such last minute, we're looking to release this quickly. And so give me a kind of rundown on what this project does.
So it's a 9-acre parcel of land that's currently owned by the railroad company in downtown Las Vegas. That property was put up for sale about a year ago. Our borrower put this property under contract about a year ago and has been working with the city to get it entitled. Eventually, this property will be turned into a 200-plus unit luxury condo hotel building, really focused on healthy lifestyle living. And so the borrower has done this many times over in the sense of acquiring land, getting it entitled, getting it shovel ready, and then paying us off with a construction loan to ultimately start the construction and development out there. That's what they've done with every other loan they've had with us. This loan is no exception. They're doing the same thing, using our money to acquire it, hold on to it a year or so while the entitlement process is finalized, the grading permit is issued, and the construction permit is approved and issued. Once that happens, the equity and debt will be in place to take us out and give them the sufficient funds to build through the construction of the property.
Talk to me about downtown. How's downtown shaping up here in Las Vegas?
Yeah, Tony Hsieh is really kind of the mastermind behind what has been a revitalization of downtown. If you may recall, Tony Hsieh was the former CEO of Zappos.
Yes.
That was headquarters here in Las Vegas, primarily downtown Las Vegas. They ended up buying the old city and county building in the heart of downtown and really changed it over.
Yeah.
The only thing to really see or do down there was Fremont Street, the Fremont Street experience, but they created kind of an arts district associated with it and really made a true central business district that Las Vegas, truthfully, kind of lacked for the previous decades.
Yeah.
Because of his vision and because of the money that he and the city kind of pushed into this area has really transformed what has gone on downtown. So this property sits right across the street from the Outlet Mall, just south of the Smith Center, the Performing Arts Center, and right next door to the heart of the Arts District.
Yeah.
So it's kind of right in the middle of everything, right off of the I-15 on Charleston Boulevard, close to it all, really.
Yeah. I think one of the best burgers in Vegas is downtown.
Really? Where is that?
Provision. Ooh, are we allowed to say that? Okay, little shout out. Downtown, but I'm not kidding you. It is the best burger I have ever had.
Well,
cool restaurant. Even I stay for First Friday sometimes to go down there and have a burger.
Wow.
Like, I crave it.
Wow. Yeah, First Friday. That's another thing that was kind of brought back, where thousands of people on the first Friday of every month go and look at local art, food trucks, bands, you name it.
Yeah. I've even bought a piece of art down there, too.
Have you really?
Yes.
Oh, wow.
To think, Carrie gets out. Didn't
know that.
It's nuts.
I've only seen you here from 6 in the morning to 6 at night, so I didn't know there's much else you could do.
There are. Every once in a while, I get out there. I definitely get out there. Well, great property.
Yes.
Reliable borrower.
Yes.
Higher interest rate.
Yes.
Low loan to value.
Yes.
Let's talk about this term for just a second. 9 months. No optional extension?
Right. So this potential loan is going on for a 9-month. There is an optional 9-month extension. However, I don't believe the borrower will actually need to utilize it. It's in there just in case they do. However, it probably won't come to fruition. You never know.
Yeah,
it's in there.
You never know.
It's their sole discretion whether or not they utilize it. If things take longer, if costs go up and they want to wait, if it just didn't make economic sense in that first 9 months, they'll wait until that second term before paying us off.
Okay.
They do have a total of 18 months, a 9-month loan with a 9-month extension, but I would expect it to go right around that 12-month mark per their usual, what they've historically done with us.
All right. Top 3 reasons why somebody would want to invest in this loan.
Demographics. People are continuing to move here to Las Vegas. It is a great place where money is coming into to flee the surrounding high-tax states. So our population continues to increase. Yeah. And as Warren Buffett always says, a rising tide raises all ships. That's right. This project is no different than that. Number 2 is a low loan to value. At a sub 50% loan to value based off an appraisal that was obtained very recently, within the past month, shows that there's quite a bit of built-up equity in this property, not only from the purchase price, but also from the value they've added by getting it entitled most of the way. Yeah. And the third reason is the historical performance of the borrower. This is not a new asset class for them. This is not a new business model. This is not a new location. This is not a new capital stack. They've always done their debt financing this exact same way, a market that they've already been involved with before, capital partners they've used before. So it is kind of a rinse and repeat. So you're de-risking the deal by kind of doing a wash and repeat. They're doing the same thing over and over again. So you kind of get used to a certain process and procedure, and it takes some of the kind of the fat out of it, and so you have it really trimmed down in a well-oiled machine.
All right. Well, guess what we need to do?
Start raising.
We got to go raise $16 million.
All right.
Hopefully we've got some investors that are interested.
Well,
I'm pretty sure they will.
Yeah, I mean, those 3 reasons.
It's a great, great investment.
I think so. I do.
All right, good. My son needed a little place to put some money, so here we go. Here we go.
Oh, we've got our first investor.
First investor. We're down. I mean, we do have to remember that he's 18 years old, so he's not.
$15,990,000 remaining.
Let's do this.
All right, let's go.
16 million. We got this.
Done.
Thank you guys for joining us today for Deeds in the Desert. We will see you next time.
Thanks for joining us this week on Deeds in the Desert, where short-term investments meet long-term investors. We hope you enjoyed the content so much that you share it with all your friends. Who doesn't like learning about passive fixed income, right? Still hungry for more education? Visit our website at ignitefunding.com. Or if you're ready to take the leap and start investing, give us a call at 702-761-0000 and schedule a free investor consultation.